Hi, everyone. This is Josh Nelson, Keystone Financial Services. We're going to get started here in just a couple of minutes. You should be able to see me, and you should be able to see the GoToWebinar tools. So as we come up on the noon hour, when we'll get started, a couple of housekeeping items as we get going. You can see me for right now. I'll turn me off after a little while here, and you can just see my slides. But I do want to make sure that there's a couple of features that you notice and can use throughout the presentation. One of those is the questions box. If you have a question, feel free to type it in there, and I'll keep an eye on that. If I can't get to your question right away, I'll certainly hold it until the end. And then there's also a chat feature. If somebody can test one of those for me, just say, hey, Josh, something like that. That would be helpful for me so I know that you know how to use the tools and you've got a way to communicate with me. So those are good features, certainly, and I'll keep an eye out if there's something that you can't see my slides or something like that. Hopefully everybody can see my slides right now. I think I've got those turned on. So once in a while, I've had that happen before, by the way, where people say, we can't see your slides. So that's a good way to be able to communicate with me. So we're at the noon hour right now, so I am going to get started. People are very busy, I realize, especially those of you who are listening in live. So I definitely want to respect your time, and I appreciate the fact that there's a lot of other things that you could be doing right now, right? You could have gone out to eat, you could have gone and gone for a bike ride or something like that. So thanks for giving that part of your noon hour. And for the majority of you, actually, we'll probably watch this as a recording. So thanks for taking the time for you as well. I always want to respect your time because I know that's one commodity that none of us can get back once it's gone. So I do want to make sure that this time is valuable for you. Over the years, that's one value that I've always placed. This is my 20th year as a financial advisor. And one thing that I've done since the very beginning is focused on client education, specifically client financial education, because I think when people understand the rules, they understand the landscape of the financial system, they make better decisions as opposed to getting emotionally wrapped up. And that's how most people that make big mistakes with their finances or even little mistakes with their finances, oftentimes it's because of emotionally getting wrapped up and not really taking the time to understand and to think through. And oftentimes not because we mean to, but because maybe we just don't understand, right? We don't know the rules. Social Security is definitely one of those things that we want to watch out for because there's a lot of gotchas, a lot of things that people tend to miss and oftentimes can make a mistake with their collection strategy. So everybody should be able to see my slides right now. I'm going to go ahead and turn myself off for right now, but yeah, I do want to make sure I introduce myself. For those of you who don't know me, I'm Josh Nelson, and I'm the founder and CEO of Keystone Financial Services. I'm a certified financial planner by trade, and again, this is 20 years in right now in this career. What I've really enjoyed is our niche of tech workers. That's the primary client that we serve is technology workers, especially technology workers at big tech companies. That really is what our best fit is, to help people manage their financial planning and their investments. So that's really our role, and we want to serve you in whatever way we can, but we do like to do financial education as a big value add to our clients so people can understand more about their money. So with that being said, I'm going to go ahead and turn myself off for right now. And again, you should be able to see my slides. Today, the presentation is called Securing Your Retirement, Transforming Social Security into a Winning Retirement Strategy. And I use that. You might think it's kind of odd that I say a winning retirement strategy as if it's a game. But the reality is finance kind of is a game. It's kind of a game that's constantly evolving. So it's not one set of rules that never changes, right? The rules change. Obviously, we're reacting to things that other people are doing. They might be politicians, the president, could be people in the bureaucracy that are changing rules and things on how these things work, right? And of course, maybe even people at the local office, the local Social Security office. One client that I spoke to this morning actually, I said, I'm going to be giving this presentation today, and what's one piece of advice that you would have? Because he's working through all this right now, the Medicare, Social Security decisions. And he said, start early, because he felt like even though he thought he was starting early, but even at that, there was a time crunch, and I think he ended up actually spending some extra money that he didn't have to on some insurance premiums based on how much time it took to actually get benefits going. So we are going to do Medicare next month. In May, we're going to be covering Medicare, but this month we're going to be covering Social Security. And there's some big decision points. Social Security ends up being a significant source of income for most Americans, and we want to make sure that we collect and take advantage of the rules that are, knowing that those rules can change over time. So a couple of things. First of all, this is all about different types of scenarios. Some people are single, some people are married. There's a big difference between those two, in that the first part of the presentation we'll be talking about just longevity and, for a large extent, when to collect Social Security. If somebody's single, they've never been married, it's fairly simple. It's just a matter of figuring out how long do you think you're going to live, right? And life expectancy is going up, up, up. Really, not only do people individually have a longer life expectancy, but if we look at couples age 65, look at that, up to a 25% chance of living to 98 for one of those two people. And when it comes to married couple, you'll find that there are differences in your collection strategy. There's differences on what you might choose to do based off of being married versus not married, because your spouse actually has some eligibility for survivor benefits. And because of that, it is important to think about how long the oldest one, the longest, would live. That would depend on a lot of things, but certainly we want to look at longevity in our past generations and then kind of pushing that forward, because we might be living a lot longer than what we think if we're thinking about how parents or grandparents or great-grandparents lived and how long they lived. Lifestyles have changed somewhat, and medicine and medical advancements that are probably going to have us living a lot longer than prior generations. So most people do collect early, even though longevity says that most people should financially wait until a longer period of time. We'll talk about the financial benefits there, but most people are taking the benefits early. 71% is the most recent stat that I was able to pull. 71% take a reduced benefit, mean that they collect early. And for our purposes, collecting early means collecting before your full retirement age, versus 29% of the population waits until their full retirement age or waits for an increased benefit, which we'll get into here in just a second. So very important that we understand the rules of the game, because the rules of the game are not always obvious. It seems like this should be a simple decision, right? But there's actually a lot more to it. And I've seen over the years, over the 20 years I've been doing this, a lot of financial mistakes that people have made not knowingly. They just didn't understand the rules. They didn't understand how things work. And so they ended up making a big mistake with their benefits at work, or their Social Security, or their Medicare, or their investments, just because of things that they didn't know. So you probably recognize this. This is part of your Social Security statement. And your Social Security statement, over the years, they've kind of changed the rules on how they send these things out. One of the rules currently that I would always apply to every single person that's not collecting Social Security is make sure you have a way to log into your Social Security account at the Social Security Administration website. Social Security .gov, or you can go to www.ssa.gov, which I've had a couple people observe to me that that's asked backwards, which is maybe a description of how some people view Social Security and the financial solvency of it in the long run. But we're not going to talk about that today. We're going to talk about things as they are, not the way that we want them to be. So it's important to think about, number one, looking at your individual benefits and the fact that those are based off of your best 35 years. Oftentimes I hear people have different things in mind as far as, well, I think it's the last 3 years that I worked, or the last 5 years, or the highest 5 years, or the highest 3 years. That's not true. It's actually not true. It's your best 35 years that they're going to look at in factoring in what kind of benefits that you'll be eligible for. So that's important to think about, is the best 35 years, meaning that you might be thinking about working longer, and or maybe there's being too detrimental to leave work a year early. It's not completely unfounded, because in some cases taking retirement early actually might be detrimental, but not a massive difference. When you're averaging 35 years, one more year, one less year isn't going to make a massive difference in your benefits. So second thing you want to look at, first of all, that earnings record, by the way, look at it. Make sure that it looks right, because it doesn't happen very often that I've seen, but once in a while somebody will look at their earnings record and say, that doesn't look right. I definitely had earnings during certain years where the earnings look too small, and I think it could be hurting my benefits. So make sure that it looks right. Make sure that it looks right based off of your earnings history. And then look at your estimated benefits. So that's the second section. In this case, of course, this is just a sample statement, but looking at three numbers, these are the three numbers, by the way, if you want to take advantage of our free Social Security assessment, we would be happy to do that for you. Free Social Security assessment will look at three numbers then. They'll look at your eligibility of benefits at age 62 and how much you would get. That's $1,072 a month in this case. Then the top number, that $1,554 a month, that would be this person's full retirement age benefit. So if this person is full retirement age at 67, that means that would be the age they would be able to collect their full retirement benefit. Now, there's an advantage of waiting longer. As you can see, at age 70, that person would get $1,938 per month, so they actually would get more if they waited. Keep in mind that it adjusts by the month, not by the year. So every month that you wait to take benefits, at least up until age 70, every month that you wait, you'll be eligible for a larger benefit. And every month that you take it early, you'll be eligible for a reduced benefit. So no matter what age you take it at, between 62 and 70, there will be either a reduction or an increase based off of how many months that you wait or take it early. The other thing to look at, again, is look at your statement. You can pull a PDF statement at ssa.gov or ask backwards. You can also do the less effective way would be waiting for them to send it in the mail. And their current rule is they actually do mail the statement now every 5 years for most people, and then it's every year actually now, I think between age 60 and the time that you actually start collecting benefits. There was a period of time where they actually stopped sending paper statements altogether. I wouldn't wait for the paper statement to show up. Just log into the website. And it's also useful because that's probably how you'll end up applying for your benefits someday, not only for your Social Security benefits, but your Medicare benefits when the time comes. You'll already have your login and you'll be very familiar with the website and familiar with how it works. The nice thing about the PDF statements too is you can save them, you can print them, you can certainly save some copies and be able to look at trends over time, so that might be helpful for you. So let's talk about individual benefits first, and then we'll talk about other scenarios like survivor benefits or married benefits. So the trade-off basically comes down to longevity. Really, there's a full retirement age factor, and if you're full retirement age, that means that you'll be getting your maximum primary insurance amount. Now, that primary insurance amount is what we talked about before. Gets gets impacted by your age and gets impacted by your work history. That primary insurance amount would be the amount as far as the starting point that you would be eligible to get your full retirement age. So reduced benefits if you take anything before full retirement age, and increased benefits beyond full retirement age up until age 70. You will never get an increase in benefit by waiting beyond age 70, meaning that you're crazy if you wait beyond that point. You're just giving the money to the government, or they're keeping it, versus you being able to take benefits. So you definitely would want to take it by age 70. To my knowledge, I don't think anybody is going to come rescue you on this one. I don't think anybody's going to come call you and say, hey, you should get your benefits. I think this is definitely one that you want to stay on top of and do what makes most sense to you. So the reduction factor is that it depends on when you were born. If you were born 1937 or earlier, your full retirement age was 65. If you were born in 1960 and later, it's age 67. And of course, in between, it would kind of phase in. You would be 66 or 66 in so many months. So they have changed this. It was many, many years ago that they made this change. And a lot of people are arguing, of course, that because of the financial solvency or insolvency of the system long term, that really this should have been adjusted a long time ago to graduate this higher, as people are living a lot longer. And in some cases, they're working longer too, so that actually helps their Social Security benefits. But this is the current rules of the game, of course, subject to change down the road. So when you think about it, there's a cost of taking the benefits early, and you might be wondering, well, how much? Really, how painful is it if 71% of the population is taking their benefits early? Maybe I should too. Maybe I should just follow the crowd. And that can be dangerous sometimes, right? Just doing what your neighbor said that they did, or maybe what your parents did when they got to Social Security age, it's really important to think about your particular situation and what makes most sense to you, not only financially, but also your beliefs, right? You may have your own personal beliefs about Social Security benefits, and I know there's arguments saying that, well, they're going to mess with my benefits, so I should take it as early as possible, or nope, they'll never touch Social Security. This is one that's politically too volatile for politicians to reduce people's benefits, and so I'm going to wait until the maximum age. Regardless of what your beliefs are, it's just important to understand how it works and how it works today. That's all we can make our decisions off of, is what the current rules of the game are, and then we adjust. So you can see it's about a 7% per year reduction by taking it early. So you got to think about that. 7% doesn't seem that bad, but really you're looking over a period of 4 years. That adds up to be a lot of money over a long period of time. Of course, if people didn't think they have longevity, then of course you want to take it as early as possible. If you don't think that you'll make it past 70 or 72 or 75, maybe it is better for you to take it early. So things to think about. Of course, these are all ones that you have to answer for yourself, right? But are you actually retiring? That's important. We'll talk about that in a bit as far as the penalty that you get in a lot of cases for working and collecting benefits early. You need to think about, are you planning on working at all, even part-time, because the earnings are not real high. There's not a lot you can earn and not get penalized if you're drawing before full retirement age. How is your health? Is there an expectation of longevity? Again, not only looking at your own family, but looking at, are you married or not? And also thinking about, well, maybe prior generations may have passed away in their 70s or 80s, but what's the likelihood that your health might be better than theirs, your lifestyle might be better than theirs? You may be aware that there are a lot of medical advancements that people used to pass away of certain things, but now there are certain cancers that can be treated or cured, and other things as well. Certainly they're making a lot of progress even on some really scary stuff like Parkinson's and Alzheimer's. So knowing that they're rapidly making progress in some of these things, there's a possibility that you'll live longer than what you might originally have thought. Are you married? Again, what's the age difference between spouses? That does make a difference. And whose benefits can the spouse collect? We'll definitely get into that later when it gets into the married benefits. So I mentioned before that you do have a reduction factor if you decide that you want to draw early, which again we talked about would be before full retirement age. And you can see the income limit in 2018 is $17,040. So every year that gets adjusted. As of last year, it was $17,040. What happens is if your earned income, so hear me on that, it's important, your earned income is going to be just your work income. This is not going to include any investments or pension income, other income that you might have. Does not include your spouse's income if they're still working. So this is just your personal earnings. If you're still working, if you make more than $17,040 a year, then you do start to have them withhold benefits, $1 for every $2 over the earnings limit. So they start pulling that back. You might wonder, well, that's terrible. That means that money's gone forever. Actually, not exactly. What ends up happening, and the same thing in scenario number 2, they give you a higher limit. If it's during the year that you reach full retirement age, you've got a higher threshold. But you might wonder, well, what happens to that money? Do they just keep it and I never get that back? The answer is no. You actually get it back. What they'll do is that once you start collecting benefits, they'll actually re-amortize and refigure your full retirement age benefit, and you'll get it, but it'll be amortized out over the rest of your life. So if you think that you're going to be working, you really want to think about how much your earnings will be, and does it make sense to draw early or maybe wait a little bit longer because you could end up just having those benefits withheld anyway. And then once you're full retirement age, and this changed, it's been a while, but it did change in that over time, what ended up happening is that they changed it so you can now work and draw Social Security benefits after you've reached full retirement age. It used to be if you were working at any age after you started collecting benefits that you'd have that reduction factor. And a lot of people said that, well, that's not fair, and you're disincentivizing people from working when they probably would like to work and be able to collect their benefits. So once you reach full retirement age, you can work as much as you want. My dad's actually still working. He actually hits the 50th year this year that he's worked at the same company, believe it or not. He's on a part-time basis now, but he's been collecting the Social Security benefits, and he earns money as well, and he doesn't get hurt. He doesn't get his benefits reduced. So one question, by the way, Jim asked, the wage and 1099 income or just W-2 income? So any earned income, any wage income, a good way to think about that is if it's income that's subject to payroll taxes. So if you would have to pay payroll taxes on the income, would it apply? So I know that some people who are self-employed, for example, they may have a couple of different sources of income from their business. They might be paying themselves a salary, some type of earnings, but they might also be paying themselves as an investor. They might be paying themselves a dividend. So the dividend part of it would not be subject to payroll taxes. The earned income would, the wage income would. So that's the best way to think of it is this income that I'm going to have to pay payroll taxes, meaning Social Security and Medicare taxes on, or not? What if you changed your mind? What if you started taking it early, thinking you weren't going to go back to work, and then somebody calls you from the company you worked at, or maybe they moved on to a different company and they say, hey, we'd like you to come back and do some work, either on a full-time basis or on a contract basis, and you say, I messed up. I should never have done that. Well, there actually is a do-over, and it used to be that you could actually do unlimited do-overs, meaning that you could always withdraw your application. Now they've limited that to once, so you only get it once per lifetime that you can actually withdraw your application. And what they'll end up doing is they'll recalculate your benefit based off of your work history. There's a couple of caveats to that, though, is that you do have to pay them back for the money that you collected during that year. So that you do have to write Social Security a check, pay it back, and then what they'll do is they will delay your benefits, and basically it's like nothing ever happened, essentially. So it used to be people could kind of play a game with this and say, well, I don't have to pay Social Security any interest, so I'm going to wait 8 years and collect benefits and write them a check, and then in the meantime I got to invest the money. So obviously, we all try to use the rules to our advantage, but that one they did tighten up. You can only do it once, and it has to be done within 12 months now of the Social Security benefits being triggered. So I don't see this happen very much anymore. We did see one client, I think it was within the last couple of years, he thought he was done. He thought he wasn't going to work anymore, and it turned out that the company he had worked for actually called him back. So he actually did turn in his withdrawal of application, wrote the check, and now he is happily retired and drawing a higher benefit than he would have otherwise. And collecting late, of course, there's a guaranteed increase, right? Guaranteed as much as you can say guaranteed, right? But there's about an 8% increase for every year that you wait beyond full retirement age. For purposes of simplicity, you'll notice that I've used age 66 as full retirement age here, but it applies no matter what age you start collecting at, whether it's 66 and 2 months or 67 or whatever that is. It's about an 8% increase per year for every year that you wait. So some people find that pretty attractive because there's not many investments that have a guaranteed increase of 8% a year, right? Of course, that's something you'd be collecting over your lifetime, but for some people, it makes a big difference, and it makes a really, really big difference for people who are heavily relying on Social Security for their retirement income. Say if they didn't have a lot of investments and pension income or para income or something else that they were going to be living off of, this might be really, really important to them because this is their primary source of income, and by waiting, it'll make a massive difference in their lifestyle once they retire. So it really does come down to longevity. It's pretty darn simple, actually. And there's one factor I'll throw in a second that changes it slightly, but it's basically if it's just an individual and they've never been married, then it's really longevity. Basically, there's a break-even point where you would have been better off drawing early. So if you didn't make it to age 78, generally speaking, you would have been better off having collected your benefit at 62 at the earliest possible age. So think about that the break-even point is age 78. And right there, sometimes people say that's enough for them to draw early. They say, nope, I don't like those odds. That's a long time that I would have to be collecting benefits before this thing breaks even. I'd rather just take my money and run. So, and that's fine. Obviously, that's just the clarity here of understanding. The 82 and a half age, that would be break even of waiting until 70. Because you think about it, that's a lot of money that you wouldn't have been collecting that Social Security was just hanging on to for you. So you do have to make it to certain ages for it to pay off. And if you think there's a good likelihood that you wouldn't make it to one of these ages, you might consider drawing early. Or again, situations, you might have your own examples or family history of an accident or something like that, and say, well, this happened and this person never collected any benefits, and I don't want that to happen to me. So all that is stuff that you need to be thinking about, of course. But again, if you're single, never been married, this is about as simple as it gets. The other factor is sometimes people will say to me, well, wait a second. So you're telling me these break-even ages, but Josh, you're not assuming any kind of rate of return on the money, because if I really retired at age 62, if I'm not drawing it from Social Security and I'm retired and I have no other income, that means I'm drawing from my investments, and my investments are going to get a rate of return, right? And that's true. That's true. We can actually do a separate analysis on that. It gets a little bit more complicated, certain, because we have to put in some time value of money factors, but we can definitely do that when we do your individual Social Security analysis. All right, let's talk about spousal and survivor benefits, because if you've never been married, the presentation, up until this point, all these examples going forward, they're probably not as applicable to you, but they might be applicable to people that you know. So it may be a good understanding of things for a loved one or a coworker or somebody else who might be in a situation where they've been married. So we're going to use an example here. We'll play with a married couple, Jordan and Alex. And we'll use an extreme example here where we've got one of the spouses that has worked and the other spouse has never worked. So in this case, Jordan has a primary insurance amount of $2,200. Alex has never worked. She didn't have any work history, and so she has a primary insurance amount of $0. Remember, that goes back to what it says on her Social Security statements. So what ends up happening is that if you've got a spouse, the spouse is eligible for 50% of the primary insurance amount benefit. And what you'll notice here is that when Jordan starts collecting at full retirement age, so we're keeping it simple, full retirement age, getting $2,200 a month, Alex at the same time now is triggered to be able to qualify for her own benefit off of that, called a spousal benefit, and now she will be collecting $1,100 per month. So that ends up being a pretty good deal in this scenario where she had no work history, yet she still gets to collect her own benefit. She still gets to put in her own application. Now, what if we changed it and we said that they drew early? Now, Jordan could take it at 62, could take it as early as 62, so we have a reduction factor. And now the collection amount is $1,650, but Alex elects to wait. She still elects to wait because she wants to get the full amount that she was eligible for. She still would get $1,100 a month if she waited until Jordan's full retirement age. She would still get the $1,100 per month because she didn't draw early. So there is this factor, again, of thinking about everything kind of starts from that full retirement age. And the reduction factors, remember, come into play. And for the spouse, they actually don't get any increase after age 66. So that's one difference between the primary person, the primary person drawing benefits, and the spouse, is the spousal benefit will never, ever, ever go up after her or his full retirement age. So I let that soak in just for a second, because a lot of people don't know that, and I've caught that for folks over time where people would come into me and maybe the spouse was 67 or 68, and we find out that she hasn't been drawing her benefit and her spousal benefit yet, and she said, well, I'm just going to wait. I'm going to wait until 70 because I'll get more. And I say, no, like that actually doesn't happen. that's not, you're basically just giving money to Social Security. You're not getting any increase. So you might as well start drawing it at this point. So we'll get at age 70. What if we waited in this scenario? So Jordan waits. We get the 8% a year. So that's 32% increase that we get by waiting until age 70. But now Alex would still get the $1,100 or not have gotten any increase by her waiting until 70. One thing to keep in mind is that the rule, which these rules have changed over the years, so it's important to think about, but the rules have changed, and that now the primary insured has to have applied for benefits before the spouse can start collecting their benefits. So in this scenario, by Jordan waiting until age 70, Alex also has to wait until age 70 to be able to draw. So I'm going to pause for a question here. Question is, Alex must be over 62 to begin spousal benefit. And that is true. Actually, that is true. So the spouse also must wait until they're 62. And if you had a big age difference, say if you had one spouse that was 62 and one spouse that was 52, the other spouse, the younger spouse, would still have to wait until his or her age 62 until they would be able to start drawing benefits. So that's a good differentiator if there's an age difference between the spouses. And again, the primary insured does have to apply for their own benefits before the spouse can collect theirs. So the reduction factor, Jordan took a benefit reduction of 25% by waiting. So it is significant. Again, it adds up over time. Jordan took a decrease by taking it at age 62. But Alex actually took a 30% decrease. And you say, well, why is that? Why does she get a bigger decrease than he does? I don't know. I don't know the why necessarily, but that's just the way it works. Is that the spouse actually has a larger reduction factor by drawing early than the primary insured. So that's just the way it works, that there's a larger benefit reduction. There might be a benefit then on that spouse to wait, or even both of them to wait for that matter. So there's a benefit out there that has gone away. I'm going to say that very clearly because a lot of people get confused by this. There used to be a strategy called file and suspend, and what that allowed the spouse to do is the primary insured actually could apply for benefits and immediately suspend their benefit, their individual benefit. But what that would allow then is the spouse to start collecting theirs. So that did change, and so it was eliminated as of April 30th of 2016. And anyone that suspends their benefit after April 29th of 2016 will also have their benefits suspended. And you'll see that in the examples going forward. So we're going to play with the example now. And so you might be talking to people, for example, that were older and they use this strategy. We're going to be assuming that it's no longer eligible in these examples going forward. So in the file and suspend strategy, what ended up happening is Alex actually would be able to collect her benefit or spousal benefit at full retirement age, and it allowed Jordan to continue waiting and gain the increase to 32%. So these are examples that we used for a lot of clients in the past, because in some cases it actually ended up resulting in them collecting a lot more benefits by them kind of playing with these numbers, and it depended on the spouse's age and so forth. Now it's gotten a little bit simpler, and unfortunately it's a tool that we don't have in our toolbox anymore, but it's important that you understand how that works in case you're talking to somebody who's older who used this strategy in the past. Now, obviously in this case, Jordan wouldn't have collected anything from full retirement age until 70, but he would be collecting a lot more at age 70. So that combo strategy. So suspending options or suspending benefits is still an option, but it's different. It works different in that we've got a situation now where Jordan could apply for benefits, taking the benefit reduction at 62. But let's say that Jordan decided to suspend his benefits at some point in time, maybe at full retirement age. He says, you know what, I messed up. I really would like to get the increases in the future. He can actually suspend benefits, which means that he's not getting a check, and it does actually start to increase his benefit again by him waiting. So kind of interesting, but now obviously that also puts the lower earner, the spouse, Alex in this case, it also puts her in the same boat. If that Jordan's not collecting benefits, then Alex also cannot collect benefits. So suspending the individual benefit does turn the spousal benefit off. In the past, that was not the case. So important differentiator. That's what's tough with all this stuff, I think, for a lot of people, is they hear how things used to work, or they talk to older people. Oftentimes, it's a good thing, right? We've got mentors and people that we talk to about what they did, and the rules have changed. They don't work the same, so it's important to recognize that. So adding spousal benefits to individual benefits, let's say a different scenario. Let's say that it wasn't so extreme where, in this case, Alex did have a work history, so she does have a primary insurance amount that she would be eligible for. And in fact, at her full retirement age, if she hadn't been married to Jordan, she would be getting $600 per month. But in this case, we've got a situation where if she took a reduction factor on her own benefit, remember it was a 25% reduction, down to $450. Her own benefit would increase 32% if she waited until 70. But in this scenario, she has a spousal benefit that does kick in. And so you actually, when you factor this stuff in, you get the better of the two. You actually get the better of the two benefits. So they would actually technically add the spousal benefit to what she was eligible to get on her own. And in the end, it actually ends up resulting in her being better off taking the spousal benefit than if she were to draw her own. So there is a reduction factor, again, on the spousal portion of that, 30%. And then, of course, there could be a benefit to waiting. Why is this all important? Longevity, we talked about that at the beginning. Longevity is really, really important to think about, not only for the primary insured, which really could be husband or wife. The higher earner, it doesn't matter whether it's male or female. The higher earner is what the benefits are based off of in the long run, in that when the first spouse passes away, whether it's the primary insured or it's the spouse, the surviving person is actually going to be collecting that higher benefit, that primary insured benefit, meaning that there certainly is a benefit of looking at joint life expectancy. How long are people going to be living? So when you think about it, women do have higher longevity, right? So that's just a fact. Women tend to live longer than men. And oftentimes they are the ones that end up collecting their husband's benefits in the long run. So it's important. Obviously, this changes over time, and more often the case, both spouses have work history now, so those are starting to change. But more than likely, one spouse is going to earn more than the other, and we need to be cognizant of that and how it affects benefits. Take a pause to sip my tea. All right, so kind of looking at survivor benefits now in light of that. Let's look at Jordan and Alex. We'll stick with our example. So Jordan, remember, primary insurance amount of $2,200. Alex had her primary insurance amount of $600. So for survivor benefits work a little bit differently. So survivor benefits are tied directly to Jordan's collection decision. And that means if he collects at age 62, he leaves Alex with significantly lower survivor benefits than if he collected at age 70. So that's one differentiator that's important, is that essentially by him drawing his benefit early, it's locking in the survivor benefit. So the survivor benefit now becomes $1,833 a month, even though she may have waited, right? She may have waited to collect her own benefit. It's the larger amount. And in the case of Jordan waiting until 70, now Alex would get the $2,904 per month after age 70. So once in a while, this comes into play where people will say, you know what, I don't have good longevity in my family, but my spouse does. So I'm thinking about taking my benefit early. As we dig into it, maybe the spouse has a lot of longevity. Maybe husband has longevity of 70s and everybody in wife's family lives to be over 100. Well, that's a long time for that larger check to be added up. And as we talked about before, it probably would result in more money being collected by waiting, even though husband may not have the same health status. So let's talk about some collection strategies. And for sake of time, some of these I am going to move a little bit quick on. So give me some grace. Obviously, some of this we're going to move quickly. And when we're going through this, more than anything, think about how this might apply to you. And remember, that's one thing that we're offering to everybody is a free Social Security analysis where we're actually plugging in your actual numbers and looking at break-even points and the best collection strategy for your situation. And all we need, by the way, for those of you who have to jump off later early, we just need to know the date of birth for each spouse. Of course, we need to know if you're married or not. And it's helpful to know, certainly, if you used to be married, say if you had a spouse that passed away, or if you were divorced and not remarried, it's important to understand that because it can certainly make a difference in collection, as we'll talk about later. So we'll need to know dates of birth, and then we need to know those three numbers from before: the age 62 amount on your statement, the age 66 amount or full retirement age from your statement, and the age 70 amount. With those numbers, the date of birth and those three numbers for each of you, we can actually do a really comprehensive analysis, and I think it'll help you when it comes to making some decisions. So let's look at a couple of examples here. So if both collected at 62, Jordan would receive his own monthly benefits of $1,650. So remember, that was $2,200 reduced by 25%. And in Alex's case, she would normally have gotten her own benefits, she would receive an additional $350 in spousal benefits, of course, so that does end up increasing her benefit. But when Jordan passes away, Alex would be eligible to receive $1,815 as survivor benefits in lieu of her own other benefits. So at the end of the day, they receive $600,000, about $607,000 back from Social Security, looking at longevity of Jordan to 75 and Alex living until 84. So you can see kind of what this would look like for you, right? If we were running these scenarios for you, what we can do is we can estimate the total amount of benefits that you would be collecting. We can play with all kinds of what ifs, by the way. You might say, well, let's assume both of us live a long time. Let's assume one of us dies really early and the other late. What if we both died early? So we can play with all those scenarios for you, and we can run multiple examples to help you come to a good decision point. Okay, so let's jump into another one. What if we waited until age 66? So both wait until full retirement age. So in this case, remember our $2,200, that's what Jordan would be getting. Individual benefits for Alex, $600. Adjusted spousal benefits, because we're bumping it up to that 50% number, right? The 50% of $2,200. And so now they're receiving what we had run through before in our original example. If they both took it at 62, they would have collected $607,000. At full retirement age, they would have collected $633,000 in benefits. But had they deferred until age 70, they would have only received $601,000 in benefits. So here's an example that based off of their longevity, it would not have paid off for them to wait. They should have taken it early, in other words. So this is exactly what the outcomes will be when we run these numbers for you, is you can see at different points, and that'll help you make your decision on when you actually start collecting. So in this case, full retirement age would have been the better choice for them. Wouldn't it help, by the way, if we knew when we were going to die? It would make this a lot easier. But Social Security benefits are obviously something we've got to make a best guess on. All right, so let's take a look at another example here. So what if there was a large difference in benefits? So now we're assuming that Alex had her primary insurance amount. She lives to 84. He still lives until 75. So now if we use a mixed strategy, we actually would have ended up with $634,000. Excuse me. And what that would have been is actually Jordan collecting her benefit at 62. And then she gets her spousal benefit when Jordan applies at age 70. That actually ended up resulting in some extra money. So there still are some strategies, even though that file and suspend strategy is no longer available. Keep that in mind. There still are some tricks we can play here to maximize the benefits. And it obviously is good from a cash flow perspective. So overall, it's important to look at the different scenarios and we can come up with that dollar amount. The other thing to think about is we can run these same scenarios using a rate of return. In other words, if I had to be drawing from my investments during those years that I'm waiting, does it pay off? Does it not pay off? And we can play with that as well, because that does make a difference. Okay, what if we did restricted application? So that's still available if you were born in 1953 or earlier, and not often the case anymore, but there are situations where we could do the restricted application, and that would allow the spouse actually to collect benefits early, and that would have been $1.2 million if they had been older, basically, if they were older folks. And then widow significant individual benefits. This is a different example, of course. Chris, primary insurance amount $2,200, survivor benefits of $2,500, and she lives through age 92. There is a scenario where if you had a spouse that passed away early, and you actually would have the eligibility to take it at age 60. You could take a reduced benefit to age 60, and I've seen people do this before. So that would be if you had somebody who passed away much earlier than expected, probably, and they want to start gaining some income earlier on. So it's still important to look at the different strategies where the survivor benefits and the individual benefits basically can kind of coincide. You could actually be drawing survivor benefits earlier on and then delaying your own benefit until later. So it matters. In other words, if you've ever been married, even if you had a spouse that passed away many, many years ago, it also matters if you have been divorced, because you might have some eligibility for divorced spouse benefits. And so we can see the different dollar amounts on the bottom based off of total collection amount. So let's talk about a couple of things just to make sure that we're clear when it comes to the collection strategies, filing and suspending. So a voluntary suspension request, during suspension, any spousal or dependent child benefit would also be turned off. So we didn't really talk about dependent benefits, but those also would not be eligible to be collected if that was suspended. And there's no retroactive payments of suspended benefits, and so you can't go back. Okay, and then restricted application, again, that's still available if you were born before 1954. So depending on your date of birth, we may have some different options available to us. So if you've been married for at least 10 years, think about that. If you've been married for at least 10 years, but you're currently unmarried, and both you and your ex-spouse are at least age 62, you may be eligible for spousal benefits under the same rules as we discussed earlier. So if your ex-spouse had passed away and you were unmarried, or your current marriage started after age 60, so it actually is a provision to get remarried. In other words, if it's later on, you may be eligible for survivor benefits. So keep in mind that's something that could end up applying to you. So divorced spouse benefits. If you were married to your ex-spouse for 10 plus years, you're currently unmarried and both are at least age 62, and you've been divorced for at least 2 years, there is some eligibility for divorced spouse benefits, depending on which one's better. Remember, you always get the better of the two, whether it be a spousal benefits, survivor benefits, divorced spouse benefits, and again, the survivor benefits. If you've been married to your ex-spouse for 10 plus years, unmarried or married after age 60, and you're at least age 60, you may be eligible for that. Taxation of Social Security benefits. Often a question that comes up is, how do I pay taxes on this stuff? Again, a lot of misconceptions. Some people don't think that they pay any taxes on Social Security. Not true in most circumstances. Sometimes people think it's all taxable. Also not true. So there's a special term here called provisional income. And what happens is that they take half of your Social Security benefit amount, and then they add in your modified adjusted gross income, which is what it sounds like. It's your adjusted gross income, and there's a few things that could change it as far as what needs to be included. For example, tax-exempt interest oftentimes would get added back into that. And what would end up happening is that in some circumstances, you don't pay anything. If you have no income, you don't pay any taxes on Social Security, of course. But when you look at the amounts from zero, if you're single, $0 to $25,000, you wouldn't pay any taxes on Social Security, or up to $32,000 if you're married, silent, jointly. Or you could be in that second chunk where 0 to 50% of your benefits are taxable or included as income. And then finally, if you're over $34,000 or $44,000, then anywhere from 7 to 85% of your benefits are taxable. You say, why these ranges of amounts? Because it depends on what your other income is. Is it earned income? Is it dividend income? Is it capital gain income? Is it pension income? So we have to look at what that other income is. Because if you're just drawing Social Security benefits, that would never be enough to trigger taxes. If that's your only source of income, in other words, you're probably not paying any taxes based on current collection amounts. If you did, it would be extremely low. Most people have other income sources. They've got a part-time job, a pension, an IRA, something else that they're paying taxes on or including as income. So these dollar amounts clearly are not dollar amounts that most people could live on. At least in northern Colorado, it's not cheap up here anymore. So keep that in mind, is that you probably will be paying taxes on a portion of your benefits. And of course, with some planning each year, we can determine how much would be included and how much would be taxable. Some people have the question, too, of can I withhold taxes on my Social Security benefits? And the answer is yes. You actually can have them withhold taxes if you want. You don't have to. You can just pay estimated payments, or maybe you're paying in some other way through your payroll or by having deductions taken out of your IRAs or other investments. So a couple of quick concepts as we wrap up here, but these are important. There's the notion of a government pension offset. What this is, for people in Colorado, this would be like para benefits. If you're a para employee, or if you have a spouse who's been a para employee, they actually are not paying into Social Security. So it's important to think about that if you're not paying into Social Security, then not only are you not contributing towards your primary insurance amount, but there's actually a rule that says that there's a kind of a test that you have to apply against Social Security. There's essentially an amount that will maximize the amount you can collect between the two. If it's spousal benefits, you could actually have your spousal benefits reduced to zero. And in the case of survivor benefits, they could get reduced down a bunch if you're collecting from those other places. So it's one thing to think about. Usually that would be cases where you would be working for a nonprofit, like UC Health, for example, would fall into this. If you're a teacher, public service employee, something like that, where you're paying into a different retirement plan and not paying into Social Security. Keep this in mind, that whether you're collecting a spousal benefit or a survivor benefit, that actually could reduce your benefits. Windfall elimination provision, that's for individuals who have substantial earnings covered by Social Security between 20 and 30 years out. If you've got more than a 30-year work history, in some cases, you actually could have been, say, a teacher for a while, and then you worked for a big company like Lockheed Martin for a while. There actually would still be a formula, but the longer you work, the less and less it would impact your overall benefits. So as you can see, it's kind of complicated. I'm not going to go through in details. I'm running out of time, but we would definitely factor this into your scenario if you have these types of benefits. And again, for a widow situation, it could end up resulting in lower benefits. The reason why I'm going through this, I'm going through it quickly at least, is to let you know that it's a factor, because I've had this happen before. Again, in 20 years, I've seen this happen where somebody saw a Social Security statement and then they saw a pension statement and they said, well, great, I'm going to get X number of dollars. And it turned out there was a reduction factor that would apply. So keep in mind that those actually could end up impacting you or somebody that you care about or love. Okay. I'm actually going to jump forward these last couple of slides. Those were a couple more examples that we could go through, but for sake of time, I wanted to open it up for questions at the end here. But overall, today, this was trying to understand the rules of the game. It's probably not going to give you a specific answer, though. That's why the Social Security analysis is important, because what I've given you today is probably not enough. Unless you're single and never been married, I probably have not given you the information that you need to actually make a final decision on how you decide to collect on your benefits. So that's the benefit of having an individual consultation. There's no consultation fee, and there's no obligation. We're just going to talk. We'll go through your stuff and figure out what makes sense to you, and we'll be running those scenarios that we talked about before, so you can actually see the break-even points, and hopefully that'll help you arrive at whatever your final decision is on your benefits. Of course, understand the options and benefits available. Sometimes people don't even know they're eligible for certain benefits. And again, this might not even be you, right? This could be somebody you care about, a family member, a friend. And ultimately, when it comes down to it, most people do have other sources. And so when they're thinking about their Social Security, we also have to be thinking about the rest of your financial situation in that. In fact, I'll pop myself on here, the webcam, just so we can see each other. But you really have to think about the rest of your financial situation. That's the fun part of financial planning for me, is the fact that everything's interrelated, right? You change one thing, it's going to change everything else. So your situation, even though you may have worked for the same company and are the same age as somebody else, you don't want to do exactly what they're doing, because their financial situation is not going to be exactly the same, right? Their family situation is not exactly the same as yours. So we need to think about your individual situation and really help you plan, factoring in all of your finances. And that's really what financial planning is about, right? Is really looking at the entire landscape of things, figuring out what you want, figuring out where you are today. And really our goal is to give you confidence by doing some good, thoughtful planning and giving you peace of mind, so you don't have to stress about this stuff, whether it's the market or retirement income, taxes, anything like that. My goal always with clients is to be able to alleviate some fear, alleviate some stress, and give people more peace of mind. So with that, I'm going to look at questions here. I don't think I see any, actually. There were a couple that came in before. If anybody has any questions here at the end, certainly throw those in. I'll also point you out to a resource in the handouts. The handouts piece of the toolbar, there's something called Keystone Financial Data 2019. Very useful 8.5 by 11 PDF that you can print out. You can keep. Really useful stuff, because it actually has things on taxes, retirement planning, Social Security, a lot of things that you would need to reference this year as you're doing your planning. So I just want to throw that out to you. That's there as a resource. Also want to make sure that people are aware that next month we are doing a Medicare version of this. And Medicare is a whole different animal that relates to your health care, decisions, typically after 65. But as my client earlier today said, make sure you start early because sometimes this stuff takes a lot longer than you think. And in some circumstances, if you actually need an appointment at the Social Security office, it's not just a drop-in. You may not actually be able to get in for quite some time. In fact, in some cases, people are telling me they've had to wait 1 or 2 months before they're able to get in front of somebody, and that's sometimes costly, of course, to have that. So keep that in mind. We're going to be talking about Medicare. We're going to have a guest speaker, Ryan Little, who's a Medicare specialist, so she'll be joining us. And that's what she does, really, is talk to people about Medicare and Medicare planning, because it's very important to understand the different types of plans that are available. And that's very, very individual based off of your circumstances, your family, and what kind of health status you've got, what type of medical expenses or drugs or things like that that could be coming into your planning. So keep that in mind. Again, I don't see other questions, so I'm going to wrap it up here for today. Thanks for attending. Certainly, thank you for your business. Thank you for taking the time out here over lunch hour to visit with me. If somebody else wants to view this, remember that we are going to record this. It is recorded and placed on our YouTube channel. If you go to keystonefinancial.com, you'll actually see our YouTube link up at the top. You can click on that, and this video will be available within the next 24 hours for you to be able to share the link. As always, thank you very much, again, for your trust, for your confidence, and I appreciate the time that we've been able to spend together. Thank you very much, and take care.